We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Hunter. He's a contrarian macro strategist with 49 years of experience, and he also offers a quarterly letter by subscription. Thanks for joining me today, David.
Yeah, hi, Tom. Thanks for having me back.
It's always great to speak with you and get your real contrarian perspective here. So I wanted to start by maybe getting some perspective on how you view the pullbacks that we've seen since the start of the year. So far, the S&P is down 15%, the Dow's down 10%, Russell 2000 is down 20%, and NASDAQ is down 24%. So where do you see the bottom coming in here?
I'm sure. Yeah, I think we are putting in a bottom here. Obviously, I don't know exactly which level or which day it's going to happen, but I think, as I've been saying, the bond market will lead the stock market, and I think we've seen the top in the interest rate. So I think we've seen the bottom of the correction in the bond market. If that's the case, the stock market's not far behind. I know everybody's looking at the Fed. I believe it's really the bond market that's done the tightening, and it will be the bond market that will lead the turn from the tightening or the pivot. So the Fed will follow, but I don't know whether that doesn't necessarily mean they don't hike rates in June. They could hike in June. It doesn't really matter to me because I think the bond market will be setting the tone. So I think we're there. Whether, I don't know whether that's yesterday's lows or whether we go to 3,900 on the S&P. It doesn't, to me, trying to pick an exact bottom is impossible. Mm-hmm. And, my focus is bigger cycles. So, I don't know. I obviously I didn't expect it to get down this low. I thought 4,300 or, the February lows around 4,100 we're going to hold, and it broke that this week. So we've gone lower. But in the scheme of things, when we go through what I think we're going to see on the other side of this, nobody's going to care whether they got in at 3,900 or 4,300. It's going to be such a what I call a very steep bull leg that nobody's going to remember that. It's kind of like going back to March of 2020. The SP got down to 2,200 or just below. It wasn't there very long. And I don't think anybody's really too concerned about whether they bought in at the bottom or whether they got in at 2,600. Once it starts moving, the focus is really on what I think is going to be a stunning, historic, what I call melt-up rally, but, big bull leg.
Mm-hmm. Yeah, and I know I've said this on the show before, but I remember Ronnie Stofferle saying that we'll leave the bottom picking to the proctologist, right?
Yeah, that's about right. And I would say, based on what I saw yesterday on Twitter, yes, they sure looked like capitulation. People were scared to death. I mean, the more they're criticizing me as probably, the poster boy for bullish call out there, the more they were almost angry and calling me a fool, etc. The more you see that, the more fear is prevalent. People are acting on their portfolios. They're nervous. So I think if we're not at the bottom, we're darn close.
So is that sentiment part of what really drives that bearish sentiment that you're seeing all over Twitter and that, everybody is feeling right now? Is that part of what drives your contrarian call here, David?
Yeah, it certainly is. I mean, I think sentiment is the hallmark of what I do. It's not a timing thing. You can't look at sentiment and say, okay, that's the bottom. But when you see sentiment at the levels we're seeing in terms of bearishness or lack of bullishness, you go back through every market bottom, and this is what you see. So it just tells you're in the neighborhood, I think.
Mm-hmm. So will the melt-up rally be broad or concentrated in some of the, let's say, the growth names that we've seen do so well over the last several years?
Yeah, I think it's going to be broad because I think you are going to see, obviously, the growth names, the small growth names have been hit so hard, the Kathy Wood types, and the large growth names, the big names, have taken a hit in the last couple of weeks, which is why we've had this next leg down. So I think both of those will play. I also think, though, that you're going to see some people still playing defensive stocks because, the economy's, I think what's going to turn this is going to be a weak economy. So you're going to have people who want to play the more defensive, less cyclical areas. But I also think commodities and cyclicals, which have been hit hard here lately, are going to turn around and do well. So it's going to be, I think, a broad market. It's also going to be both small and large cap, I think. So it's going to be, I think, a very broad rally. And people may look and say, how can you be so bullish when you're talking about an economy that I think may actually be in recession now? If we get another quarter of negative GDP, obviously that's the definition of recession. And I think the economy is weaker than most people realize right now, including the Fed. That's essentially why I think we're not far away from a move here. Is as the data comes in over the next several weeks, I think it's going to start confirming that the tightening is already taking place, that it's hit the economy pretty hard in housing, in autos, in retail sales, maybe to some extent, because savings has been drawn down. Credit card use you're seeing go up pretty dramatically in the last month. I think that's more the fact that they don't have savings to draw from. That a lot of what we got from the government is gone, and inflation's eating away at people's budgets. So I think you're going to see, whether it's this month, next month, the following month, you're going to see, I think, an economy that's much weaker than people realize. And I think the Fed's going to react to that and say, okay, we once again, maybe we went too far. I'm not sure they'll understand they went too far, but I think they did. And it's funny because they've obviously just gotten started, but the bond market's really doing the tightening. So, that spike in rates, the 2-year going from almost zero up to 2.5, 2 3/4, and the 10-year going from 40 basis points a couple of years ago to, and certainly, going up 150 basis points recently. Those moves, it's that rapidity of the rate rise that I think really changes things and hits the economy. It certainly hits mortgage rates, which in turn have slowed housing, I think. And anywhere where credit is involved, it certainly, as the 10-year went up and the mortgage rate doubled, refis are shut down. So that's always been a source of spending, and that's gone. So I think we're going to find, as always, the Fed is data dependent, and data is late. It's a lagging thing. So if they're waiting for data, they're almost by definition going to be late. And people are looking at rates and saying, well, they've only hiked, 3/4 of a point. They're just getting started. And, all the futures are pointing to it being 7 hikes this year and another 7 next year. And the irony may be they don't get much past 2 or 3 hikes. And I think that pivot, and again, the bond market will signal it before the Fed, that pivot is what really drives this move up.
So you don't think that they'll get the proposed amount of hikes that they have signaled to the market here? They might get one more, but overall, you think they're, really going to pivot from their hawkish stance that they have postured to the market?
Yeah, just like I think the bond market forced their move into hiking, where they were fighting it, and Powell was fighting. I think it was really the bond market, along with some inflation reports, that finally got him to say, I got to act. I think the same thing will happen in the other direction. The bond market will force the Fed's hand. And, I might be wrong. It could be, we hike in both June and July. At this point, Fed funds are catching up with the rest of the rate hike. So it doesn't really matter. But I'm just saying there's a decent chance that it might be 2 or 3 and done. And I will say, I believe this is high in rates, the 3.19 yesterday in the 10-year, the 3.25, or thereabouts in the 30-year. I think those are high water marks for the cycle. I think from here, rates move down. I'm calling for a 0% 10-year next year, and it could even be negative rates. It's not going to go there in a hurry. I think they're going to be ratcheting down over the next several months, and then during the bust, they really go south. But I think we're looking at the highs in rates right now, and they're rolling over, and I think rates are down from here.
Mm-hmm. So you touched on mortgage rates as well, which obviously really affects the housing market. So do you think when those come back down, that will spur another real rally in the housing market that we've already seen be really red hot over the past 18 months?
The trick is how far rates going to come down, how fast. So mm-hmm. I can't tell you whether we move from 3.20 on the 10-year down to 2.5 in the next 3 months, or whether we move down below that. So it depends on how fast rates come down. I think 2.5 is probably a good bet for this summer, and 2.5 means you could see a half point come out of mortgage rates. I think it'll spur some activity so that if housing was starting to really slow down here, you could see a pickup. I'm not sure that we're going to see much higher prices than we've already seen. I do think home builders have demand, and I think they will continue, through the next couple quarters. But I think we're looking at a peak in housing this year, whether we've seen the highs or whether we make minor new highs. My guess is we've probably generally seen the highs in activity and highs in price, and that what we see in the next 3 to 6 months is kind of filling in between those highs and whatever weakness we've had recently, which hasn't been a lot, but it's, you are seeing some prices come down a little bit and things like that. So I think this just kind of props housing up for a few more months, or 3 to 6 more months. Mm-hmm. And, of course, I'm saying this, if we've started a recession, it will then move into a bust by the time we get into late this year, early next. And so even though during that time rates could really slide to new lows, so below 40 basis points on the 10-year, and the mortgage rate could go down to 2%, the problem is it's happening because everything else is falling apart. So mm-hmm. It won't be rates that are hurting you at that time. It's people's financial conditions and the bank's unwillingness to lend.
Mm-hmm. So you mentioned that the Fed is very heavily data driven. So if we take the CPI print, for example, this is a year over year rate of change metric. So is it possible that people start to see this ease off simply because that year over year comparison won't look as dramatic despite the absolute price levels that we would still be at?
Yeah, absolutely. I don't know what tomorrow's number is going to be, but there's a decent chance that it's low. I know there's some people out there saying, no, it's going to be even higher. I have no idea, but I think there's a decent chance that it comes in just from the mechanical nature of it, mm-hmm. Starting to show that it's rolling over. It may or may not be something that triggers a rally. Investors could ignore it and say, pundits could say basically, yes, it's there, but it's technical, and that inflation's still a problem. Who knows? But I think over the next several months, definitely that mechanical, along with the hit the economy is taking, is going to cause inflation to come down pretty dramatically. I would not be surprised. I know there's an estimate out there I just saw of 3-something on CPI by the end of the year. Mm-hmm. One of the big banks is forecasting. I think that's very possible, and it might even undercut that. So all this worry that we're on 8 on our way to 10, and that's undercounting it. I think we're at the height in inflation fears, and I think going forward, inflation is going to be something that the Fed's going to be able to say, we got to worry about the economy now because inflation, and we can because the inflation is starting to come off. Mm-hmm. Added to that, maybe, and again, I've been wrong for a while now on oil, certainly since Ukraine. But I think there's a real possibility that oil has peaked and that we'll see it down towards 80 and maybe down towards 70 over the next 6 months. And if that's true, again, along with gasoline prices following that same pattern, that gives Fed breathing room as well. So right now, it looks like the Fed's sole focus is inflation. They don't care about the markets. In fact, they want the markets down because it eases financial conditions. They don't care about, seemingly care about the economy. I think that all changes in the next month or two, and the economy is going to be center stage.
Mm-hmm. So, do you think that let's say easing of energy prices comes in because of the demand destruction that the slowing economy really puts on, let's say, a lack of demand for energy?
Absolutely, that's probably the biggest factor.
Mm-hmm.
I think you're going to see some supply increases. It's just inevitable that, there's been enough consternation about the tight supply demand. There's certainly been a run up in price. Oil companies aren't, wherever they're able, I presume they're going to allow supply to increase. Mm-hmm. I think OPEC will allow some increases. So I think it's both, but it's probably the easier one to call is the demand destruction. Mm-hmm. I think it just I'm maybe out there right now, but my belief is the economy is weaker than most people think.
Mm-hmm. So when we think about the drivers of inflation, commodities have driven much of this because of the cost of raw materials and the supply chain breakdowns to get these materials to manufacturers. So do you foresee a pullback in the commodity prices as well?
I do. I'm not sure it's going to be a straight line. I mean, I'm still calling for a $6 copper number. And I could be wrong on that. We may have seen the highs, but I still think some commodities, as the market turns around, as the economy or as investors get more bullish, I think commodities may go that direction too, even though the economy itself is starting to roll over. So, for instance, if home builders start picking up because rates come down, obviously that's going to put stronger demand out there for lumber and for copper, et cetera. So I think it's going to be kind of a two-way street for a little while in commodities. We're certainly going to peak this year, but I think through the summer and early fall, you could have some bounces in commodities. They've come off, obviously, of late. I think they could have whether it's a counter trend or a move to new highs, I don't know, but I think you'll see some strength there.
Mm. David, you and I have spent some time in the past really defining terms to make sure that we have a proper understanding of the specific words that you're using. So I'd like to get your take on the difference between a market call and a cycle call. Does the timeline not matter to you as much when you're making one versus the other?
Yeah, it's probably the biggest problem I have out there, and I create some of it myself probably with tweets. But mm-hmm. A market call, I mean a trading call. What I typically say is it's not a trading call; it's a forecast, mm-hmm. Or a cycle forecast. A trading call obviously has a very defined price expectation, a very defined timeline. Whether it's very short term or a little longer. Whereas I'm trying to, I'm not so worried about the path to my targets. I'm calling targets. So when I have a 6,000 target, for example, I raised my target on the S&P to 6,000 back in January, in my January letter, early January. I was at the same time in that same letter saying we're entering a correction, that the highs of the end of 2021 were going to prove to be the highs for a while. And we were going to go into I thought it was going to be a 6 to 8% S&P correction, a 10 to 12% NASDAQ correction. It's obviously proven longer and bigger. But so in the same letter that I was calling for that correction, and it was just starting, I raised my S&P estimate from 5,300 to 6,000 because I'm not worried about the short term. I'm trying to forecast where I think it ends the cycle. And, I do put some targets out there for the correction. I said it could go to 4,300 or, NASDAQ down to 14,000. Again, it's still not meant to be a trading call. It's meant to say these are just parameters, give you some idea of what I think the correction could look like.
Mhm.
So if somebody's trading options off of me, they're making a huge mistake. And what I think frustrates people is I'm not afraid to change timing. As I say, the market's in charge of the cycle. If the correction lasts 6 months instead of 3 months, I'll push out my time for the melt up. So it's, I'm really recognizing the reality that, this is a long, that cycles are years in length. And I'm not really worried about being, when I put out dates, it's usually to say at the earliest, if everything fell into place, we could get there by this.
Mhm.
If they don't follow that script, then it's going to be longer. And again, I don't put all of that in a tweet. So when people see a tweet, they take that date as date certain, and it's not meant to be that at all.
So when we see these pullbacks, do you, let's say, adjust your forecast and your targets as proportionate to the length and the depth of the pullbacks?
Yeah, for example, and this again is caused some people to be upset, but I'll say looks like 3 to 6 months for the melt up, meaning it's that's the length of it, that's not when it starts. So I started saying that I think probably in early March. I'd been looking for it to happen. Initially, I thought it would happen by the end of the second quarter. Then I stretched it a couple months into the summer and said, looks like it, take a little longer. And probably in early March, I started saying 3 to 6 months. Well, I'm still saying 3 to 6 months. I go, well, is that the same 3 to 6 months? And I go, well, it's 3 to 6 months from when it starts. Mm-hmm. It's really the length of the up leg is what I'm measuring. So, if we're starting it right now, 3 months from now is, August, and 6 months from now is November. So it's somewhere in that time frame is kind of what I would expect. If the consolidation goes on for 2 more months, it pushes it out a bit more. And it's not meant to be precise. I'm not so worried about, as I say, this is the top of a 40-year secular bull market. I'm not so worried whether, I'm not going to be able to time it to the month. Mm-hmm. Or if I do, it's, the closer I get, maybe I will, but, it's really, that's incidental.
So how does the, let's say, investor psychology play into your thesis? Is FOMO what truly makes this melt up so steep?
FOMO will certainly play a role. I think it's the combination. We're in a very historic and unusual cycle in that we had a pandemic. We printed money at levels that we've never printed money before. Many, many multiples of anything we've ever done before. It led to a recovery that was not across the board, but it certainly poured a lot of money into markets. And so we're nearing the end. From a different perspective, I'd say we're nearing the end of a 90 or 100-year super cycle, which is what I define the big cycle between two depressions, the 1930s, and what I think will be a depression in the 2030s. So we're in the last decade of a super cycle. Everything in super cycles, going from bottom left to upper right, the slopes get steeper as you go farther along. And so the culmination of that super cycle in the market is the final steep leg. And yes, we've had, you could make the case we've had that steep leg from March 2020 to December 2021. And as I say, that was a melt up. I mean, it was parabolic. It was a melt up. I just believe because of sentiment, because of what the Fed is, the way the Fed is managing this, because of a predictability of how the Fed will have to respond, I think you're going to see that even though we are technically starting the downturn already, the bust doesn't show up or isn't, investors aren't going to see the bust until late this year at the earliest. So during that period where you're still kind of debating how weak is the economy, the Fed's coming back around to helping us, the wind's at our back instead of in our face, that fuels the rally. And I think because of where we are in the cycle, because of the extreme negative sentiment that has been acted on, because of the nature of our investors, how they're traders today, not investors, many more are. They've acted on the sentiment in ways that investors, decades ago wouldn't have. Decades ago, they would say, "Hey, we ride through it. We raise a little cash." Today, obviously, with hedge funds and derivatives and everything else, people act on it. Now, they may act on it in the last piece of the decline. I think there's been a lot more selling probably in the last month than there was 3 months ago, right? When it was higher. So psychology takes you to that point where you finally throw the towel in. And that means that's all fuel for the next leg. So when it does turn, not at the bottom, but as the tape moves up, as the momentum gains, those people on the sidelines are going to commit more and more of their cash because things are looking better and better. And then at the top, everybody's going to be all in. And so if this is truly the top of a 40-year secular bull market, I expect bullishness at that point to be the highest it's been in a long, long time. And for most of the cash on the sidelines to have been committed, at least, reasonable cash on the sidelines, not people's savings that they don't plan to commit, but pension funds and insurance companies and whoever will be maxed in equity markets and at the top, I can sit here and talk about a bust coming. At the top, people are going to be just as apoplectic about my view then of saying I'm super bearish as they are now for me being bullish. So, that's how psychology works. Is it's very hard to. Everybody claims to be a contrarian, but the true contrarian is what I had to do yesterday. And there were I was a very lonely contrarian bull yesterday. As far as everybody was concerned, I didn't know a thing about markets and I didn't know what I was talking about. And maybe I don't. We'll find out. But at the top, it'll be very much the opposite where, I'll be a lonely bear and people will be telling me why this thing can run, why we've had our sell-off back in the spring. Sentiment was so low. That was a true bottom that has years to run out of. And so, you're going to see it's very hard to reverse, to be opposite of that. And I think that's probably the most predictable part of this is how sentiment will react.
So considering, let's say, the way that you're reacting to this market, have you moved over the last couple of months to more of a defensive position, more in cash, or how do you treat that?
Yeah, I never talk about what I do personally or provide any advice because I'm a macro strategist. I can't. And it's hard for me to comment because whatever I say in terms of positioning is a form of advice, so I can't really say. But people can use logic and understand that if you're trying to buy low and sell high, you want to reverse what most people do. Most people will be selling near bottoms and buying near tops. And you want to reverse that, which is hard to do because you have to go against your gut. Your gut.
The old saying, maybe the old saying of hold your nose and do the opposite, right?
Right. And obviously there's a reason why people are bearish yesterday or now. Their fear is that this is just the beginning of a much deeper sell-off. That we saw it all yesterday. People are calling 3,500, 3,000. And NASDAQ could be down 50%, et cetera. So obviously the momentum is going in that direction. And they just fear that there's a lot more to come. and they have reason from a fundamental standpoint to be nervous because the Fed's telling them they're just beginning hiking cycle. Mm-hmm. And they're saying, well, if rates have that long to go, it's way too early to be bullish. So I understand the viewpoint, the bearish viewpoint, but as I said, sentiment is probably my biggest piece of my work, or the thing that drives me the most. Mm-hmm. And sentiment is as low as it gets. I mean, bearish sentiment right now is at levels above, in some respects, above March 2020, back to levels that we saw in the 08-09 period. And yet, the market is almost, the market more than doubled in the last 2.5 years, and is, yes, it's off, but it's still almost a double from where it came from in March 2020. So to have that kind of run and have sentiment this ridiculously bearish is a very bullish sign, in my opinion.
So, David, I'd like to kind of move a little bit to talking about the conflict in Ukraine. Has it affected the markets, in a way that you didn't see coming? And the other part of that I'd like to get your thoughts on is, how is let's say the move away from the dollar going to affect it long term?
Okay, so first, I would say Ukraine, the most obvious place where it affected my forecast, or where I was wrong because of Ukraine, was oil. Because I think without Russia going into Ukraine, my call that we were close to a cycle top around 85 on oil, I think would have proven correct. And it obviously spiked to 125, 130, and is now still over 100. No question, Ukraine impacted oil prices. So I didn't see that coming, or I was wrong on where oil would top out. Mm-hmm. I still think, though, that ultimately that turns out to be a 3-month deviation, and that ultimately we roll over. So I don't think it's a huge factor longer term, but it was a factor in the last few months. And that's true across the commodity spectrum. I think, a lot of the commodity prices probably were impacted by, the sanctions and the issues of commodities that come out of the Russia-Ukraine area. And then obviously going to what's going on with the dollar. Yes, Ukraine and the sanctions seem to be speeding up the move away from the dollar that everybody's been talking about for years. Mm-hmm. Remains to be seen. I don't think it's something that's going to happen overnight. I don't think, I think it's easy to get very bearish about that when everything else is kind of hitting the market. So it's just one more thing, and the dollar moved up. I personally think the dollar is topping here, and I still think you're going to see a big rundown in the dollar over the next 6 to 12 months. And that will probably ease some of the concerns about the longer term impact on the dollar as a reserve currency. But ultimately, I think we're moving in that direction. Certainly, there are lots of former, what we thought were close allies, that are starting to move away from us, Saudi Arabia being one. And that, those things, they're not going to happen quickly, but they will happen. So it is a sign that, over the course of the balance of the decade, the dollar is not going to have it easy. And the dollar's obviously been a main reason why we've been kind of the king of the hill. So it is longer term, it's a concern. Mm-hmm. Near term, for my melt up, I don't consider it a big deal.
Right. So in a way, that dollar weakness is going to be accompanied by or a reason of people rotating back into the market once it starts to melt up, right?
Yeah, I think if you look at the last several months, obviously we've had strong dollar, higher interest rates. If we get the reverse of both of those, I think it helps an awful lot in terms of, wind at our back along with the Fed. If we can take what have been very strong headwinds and turn them into tailwinds, it really helps.
Mm-hmm. Do you have any thoughts towards what will ultimately replace the dollar, David?
No, let me put it this way. I don't think it's crypto.
Mm-hmm.
I think it's probably some basket. I'm sure it's going to come out of the IMF. It's going to be some kind of a basket of currencies. What becomes problematic is my bust forecast. Where I'm talking about what I think could be the worst financial crisis in history, meaning worse than 2008-9 certainly. It really, I think the place that takes it maybe gets hit the hardest is Europe. Mm-hmm. And so I'm not sure what the euro is coming out of the bust. So that's a big replacement currency for the dollar. If you're going to have a basket, you would think it'd be a basket of the dollar, the euro, the yen, probably maybe the yuan, and some others, Swiss franc probably. But if the euro is really in trouble, long-term trouble, where do you go? So it's probably going to be a lot of currencies in some sort of a basket, but I think they're not going to have an easy time coming up with something that really facilitates the way the dollar has.
Mm-hmm. So, David, do you think the relative strength of the metals over the last month or two here has been a good sign, as we've seen many indices be really more volatile than gold and silver?
Yeah, I would say it's the beginning signs that we are seeing, gold and silver start to be recognized as an asset again. They've really lagged almost every other asset class for, much of this cycle. And it's the early signs that, at least it's starting to perform on a relative basis, and then should start seeing more absolute performance as we move forward. But frankly, this weakness this last several weeks has surprised me. I just didn't expect it to get this weak. So I think we got to see where it kind of finds stability. Mm-hmm. And it's not doing it yet. But my targets are pretty aggressive, and I haven't changed them. I'm still very bullish. I just, in the short run, it's hard to figure out, why this weakness. You could argue before it was dollar strength and higher interest rates. Mm-hmm. Well, the rates have really turned around today and yesterday, and yet, gold and silver are still weak. Gold's holding up better than silver, but and silver may be, more of a economically sensitive metal. But ultimately, I do think we're going to come out of this consolidation, and gold and silver will be leaders.
When we start to experience the melt up, David, do you think that the entire metals and mining complex is going to join in that rally?
Yes, I would say they're probably going to be a leader in the rally. So, I'm looking for 3,000 gold and $50 silver. I think the miners will reflect the moves up in the metals. So I think miners should be very strong from here. Many of them could double from here.
Mm-hmm. And of course, after the melt up, you and I have spoken before, you're calling for something like an 80% decline, this big deflationary bust. So do the metals really get taken out as well as, we see basically everything get margin called, for example?
Yeah, I think you saw a little bit, very small microcosm of it yesterday, that it was pretty much everything was being sold. Mm-hmm. So I think you will see a bigger form of that during the bust. If you have an 80% bear market, you're right. There's going to be a lot of margin calls. There's going to be a lot of people raising cash wherever they can. The metals themselves, I don't think they get much below the levels we're at now. Certainly not gold, and I would think not silver either. probably hold up above these levels. So if I'm right that gold goes to 3,000, maybe it comes back to 1900, 2000. That'd be a pretty good hit, but still, not all the way down. Silver, if it's up at 50 and comes back, might come back here, or might, stay high 20s or 30. A big hit, but not all the way back. The metals, I would think are going to get hit pretty hard because they're, stocks. And so I don't think it's going to be easy to buy and hold these through a bust. I mean, I think there's going to be plenty of volatility in the miners. Should be a good next, 6 or 8 months, and then look out.
Mm-hmm. So once we really reach the highs that you're calling for, David, is there a particular break in the market that will act as a catalyst to really precipitate the crash that you're foreseeing?
It's hard to know exactly the shape it'll take. A pretty standard one is that you get a very quick leg down. Let's say you're at 6,000 on the S&P and you're down whatever, 1,000 points or 1,500 points. And then you have a rally back that doesn't get all the way back up, rallies back 2/3 of the way and fails. And then, a much bigger sell-off gets underway. That'd be the most standard way I think you could see it, but who knows? I mean, if it's event-driven at all, if something really kind of happens fast, you could have more of a flash crash where you're down 50% before you know it, and then you spend 2 or 3 months in a bear market rally before the next leg down. So it's impossible really to know. We haven't even had the bull leg yet. So, but what I do want to say is that this bottom we're putting in now, if I'm right that this is the bottom, I think this looks a lot like the bottom in early 2016 or others. It's not just a rally. I mean, it may happen very fast, but you're going to see stocks move a long ways in a hurry. Mm-hmm. So it's even though it's not going to be I don't think it's going to be a 1 or 2 year leg. I think you're going to get that kind of returns in 6 months or less.
Mm-hmm. Excellent, David. Well, I think we've run through a good portion of your thesis and maybe gotten a good understanding of it. Is there anything else you'd like to touch on before we wrap up today?
Let's see. I guess the only thing I would say is just that a lot of the things that have been hit hard, hearing a lot of talk out there about the FANGs being so overowned and so they have a long ways to go. And just understand it doesn't all happen now. I mean, they've been hit. People need to do their homework and not get too caught up in the prognostications out there, because psychology is a big part of those prognostications. Okay. Not just FANGs, but everything.
Mm-hmm. Right. Of course, your Twitter is very controversial, let's say, but that's at David H. Contrarian. And tell everybody about the letter that you write, the quarterly letter.
Okay. Yeah, it's my Twitter handle is actually at Dave H. Contrarian. Mm-hmm. Not David, but Dave. And I'd say my Twitter feed isn't so controversial as the posts are. The responses are. There's mm-hmm. lots of people out there with all kinds of opinions on me. So, but in terms of the letter, I do write a quarterly macro letter. Again, there's no advice in it. It's just really my forecast, and it lays out probably better than I can do in a tweet or in several tweets my thesis and why I believe what I do. And so people who subscribe have a better understanding of where I'm coming from. It looks a little crazy when you stand alone out there making these extreme forecasts, but there is a method to the madness. Mm-hmm. So I do write a quarterly letter. It's for a fee. If people are interested in it and want to know how to subscribe, they can direct message me on Twitter, and I'll give them details, cost, and and everything else.
Perfect. David, thanks so much for your time today. Really appreciate it.
Okay, Tom, good to see you again.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.